Matt, derivative income funds have grown from about 10 billion 5 years ago. Now it's over 150 billion. So what's driving the growth? What's driving the popularity?
Yeah, investors are on a search for alternative sources of income, and they're using the options markets to do it. As you said, if you look at the ETF world, more than 100 billion in assets tied to derivative income strategies, largely covered call strategies. If you go to the structured note space, derivative income dominates there as well, but it's through the auto-callable.
And what exactly does auto-callable mean? What are the benefits?
Sure. You could think of an auto-callable note a lot like a bond that pays you an income level, a coupon, and returns your principal value as long as the equity markets don't fall too far. So you've got an income payment, you've got principal value, so long as the markets don't fall too far.
And Calamos recently released an auto-callable income ETF. This is your CAIE. So can you talk about how it came about, how it's doing so far? And also JP Morgan's involved with this one too, right?
JP Morgan is our swap counterparty. So there's essentially three legs to this stool to bringing CAIE to market. It's the first of its kind auto-callable income ETF. We're taking that auto-callable structured note space, bringing it into ETF. So JP Morgan is our swap counterparty. This is a ETF that uses swaps. We trade that back and forth with JP Morgan. And then we've also partnered with Mercube, a leading index provider, to deliver this auto-callable strategy into the market. Calamos is the issuer. We launched at the end of June. We're over 140 million in assets just in a couple short months here.
And the goal is to squeeze a little bit more yield out of it. So why not just get a high yield ETF or a normal derivative ETF?
Sure. You look at, you use the word normal. Let's go to the covered call space. That might be how people are familiar with derivative income today. You sell off your upside, you get a coupon or an income level. That income is going to be variable based off of market volatility. But here we can stabilize that income around a high level using an auto-callable strategy. This is a lot like a long-dated put strategy with a coupon.
So where does it fit in a client portfolio? Is it on the fixed income side because you're getting all that income? Is it on the equity side? Where do you tuck it in?
The total return will look a lot like an equity strategy. So we're encouraging and focusing on the equity replacement. People who want income might be able to substitute equities, get a volatility profile that looks similar, but then have a high income payment. The income that we're seeing off of the index right now is an average of about 14.5% per month.
And then finally, because it is a bit funky, excuse the expression,
That's fine.
What are the tax implications of an auto-callable ETF?
Yeah, I'm glad you brought that up. Specifically, this is extremely tax advantageous. If you buy auto-callable notes or even a lot of covered call or derivative income strategies, a lot of that income is tax inefficient. It's treated as ordinary income. Sometimes it'll be a 60-40 split between long-term, short-term gains. Here, a majority of the income that we're deriving from CAIE is anticipated to be tax deferred, and then you'll pay long-term capital gains when you sell if you've held for longer than 1 year. So largely tax deferred income.
All right, well, thanks for coming on and talking about it.
Thank you.